Let's talk money.
Hello and welcome to another edition of Let's Talk Money with me, Surabhi Upadhyay. The passive investing industry is slowly but surely making its presence felt in India. Out of the total mutual fund industry AUM of approximately 72 lakh crore rupees, almost 12 lakh crores is now coming in from passive funds. By the way, when I say passive, I mean funds that hug an underlying benchmark index, funds where stock selection is not left to a human fund manager. So this industry is surely growing. So how should we investors use passive investing to our advantage? How do we use it to build long-term wealth? That's what we're discussing on the show. And joining me to talk about this are two representatives, people, AMCs that are in the business of passive investing, also active as well. We're not, ruling that out. Well, let me welcome my guests, Anand Vardarajan, Chief Business Officer at Tata Asset Management, and Vishal Jain, CEO at Zerodha Fund House. Gentlemen, thank you so much for joining in. I'm really looking forward to this session because we have with us today one young fund house of India that's all passive. And then, of course, we have Tata AMC that gives investors a choice of both active and passive. So let's start by getting your bird's eye view on where we are, that number that I just spoke of, right? I mean, almost 12 lakh crores of AUM. So Vishal, you go first. And why has Zerodha chosen to go all passive? Let's start there.
Well, you said the numbers, 12 lakh crores, approximately about 75% of that is in ETFs. And I think about 25% of that is in index funds. We've seen a huge growth, especially in the last couple of years in terms of traction, in terms of, retail investors. So if you looked at the history of passive investing, which started off in the early 2000s in India, I would say the first 15 years was taken by traction coming in more from institutions. Say from 2015 to 2020, traction started from HNI side, and over the last 5-6 years we are seeing traction now coming in from the retail segment as well. If you look at number of investors who are using ETFs, currently there are approximately about 1.8 crore investors using ETFs, and that growth, if you looked at the last 9 months, if you looked at April 24 to December 24, approximately about 45 lakh new ETF users have been added. And 45 lakh new investors, 45 lakh investors were what we had accumulated in the first 20 years of ETFs. So that is what has got added in just 9 months. And approximately the same number of investors, about 45 to 50 lakh folios have been added in index funds as well. And those numbers speak by themselves that now traction is even coming, from retail investors. When it comes to Zerodha Fund House, the main reason why we have, why we are there is because of the fact that at this point of time, if you look at penetration of mutual funds, you have about 5.4 or 5.5 crore unique PAN folios in India. And that's approximately just about 3% of the Indian population. And we feel this number needs to go up far higher than what it is. And we believe that, if you want the next, say 15-20 crore investors to come in to mutual funds, you need to give them simple products, and what could be simpler than introducing passive products to them.
Okay, absolutely. But whether all passive products are simple or not, that is a conversation that we'll get into later, because there's a lot of product evolution also happening. And Anand, let's start by getting your take. So it's very simple. When you talk about a passive fund that will simply replicate the Nifty 50 instead of picking your brain too much on this stock versus that stock. That sounds like a very simple concept. But now you have new indices coming up every day. The exchanges, BSE and NSE, are creating newer and newer indices, and there are more and more products coming out on these indices. So where are we headed?
See, I think we'll have to offer the entire plethora of options to investors, and it's really up to them to choose whether you are a sophisticated client. I think Vishal outlined the cohorts of clients who've entered this space over the last couple of years. And I think about it this way, that their needs, their evolution in terms of understanding of each of these could be at different levels. A simple Nifty 50 index could be a starting point, and as investors get sophisticated, they may say, okay, can I get something better than that in broad market index? Can I look at a mid cap or a small cap, or can you give me a smart beta passive, or these are sectors which we think are in vogue, there is a cyclical play in some of these sectors. So, I would like to invest in some themes or some sectors which can give me additional alpha, where I see some structural change or cyclical change. So, these are the kind of options which one would like to have, and you would like to have a full suite of products as far as passives are concerned.
Absolutely, and I mean, and I track the monthly mutual fund data pretty regularly, and even there, most of the times when you see the NFO category, a lot of the launches are actually on the passive side. In fact, let's pull up these numbers if we can. Let's talk about FY25, the year that just closed out. So if you're looking at the data coming out of the Industry Association, AMFI, then we had a total number of 150 mutual fund schemes get launched on the passive side. 102 of these were index funds. There were gold ETFs, 3 new gold ETFs that got launched. Gold prices, of course, running away, so that obviously was aiding sentiment. And then there were other ETFs, which were 45 schemes that got launched. So yeah, that in a nutshell is telling you how the industry evolved in the last 12 odd months. So, you know, for a lay investor, like I said, it's easy to understand that Nifty 50 to hona chahiye. It's simply mirroring the index. But then what should be the next few steps, Vishal, for a person who wants to use passives in a more evolved way to complement an existing portfolio?
So so the beauty of passive products, Surabhi, is the fact that, look, you can create many different cuts and themes and sectors and segments, in a passive product. But I think what investors should always be aware of is that build a good asset allocation mix. You should not just be loaded towards equity or one particular segment or a sector. It's good to have a good, an asset allocation mix, across equity, debt, commodity, and through passive products, you can take exposure to all the 3 segments, all the 3 asset classes that are there. So in your equity portion, you can have exposure to, large cap, mid cap, small cap. Now you can make a mix of these 3 categories depending on your risk-taking appetite. Now, if you're somebody who wants to take a lot of risk, you could load your portfolio more towards small caps and mid caps, right? But if you're somebody who's very conservative, you can, kind of take exposure larger towards large cap. One good way is also to kind of, have a good asset allocation across debt and gold as well. Gold has a very low correlation with equity. So the day you add gold to your portfolio, it brings down the risk of your portfolio. So that's one way to, kind of use passive products and build a good asset allocation. There are always, so you can look at a portfolio as a core and satellite, where your core becomes passive and your satellite becomes a place where you can go and take additional risk, which could be through an active fund, which could be a sector, thematic. Now you could decide how you want to play the core and satellite bit. Do you want to have a 75-25%, or do you want to have a 60-40%, or something that you can decide based on, your risk-taking appetite and financial needs?
Absolutely. And the thing is, you have products on both sides. You can build this core and satellite portfolio through active funds or through passive funds or through a mix of both. The question is, what's the right balance? And here, let's start by addressing the large cap category, because traditional wisdom has been telling us that when it comes to large caps, perhaps it's time to play a large part of that through passives. One advantage, obviously, is that passive funds are cheaper. I mean, the expense ratios are much, much cheaper than active fund management. So there, Anand, what would you say? I mean, have we come to a time where, say, 50 to 60% of my large cap requirement should be met through passives? Or is there still a case, at least in India, to put some money, into active management, even for large caps?
See, there are 3 ways there are a couple of nuances that we have to understand in as far as even large caps are concerned. One is, you'll have to look at which phase are you in. I mean, it's like just like in monsoon season in Mumbai, it rains heavily. You just don't know which day it rains. Similar the case with active versus passive, if you were to think about it. And we really don't look at it as active versus passive, because if you were to think about 2016 to 18 phase, you had a situation where passives did extremely well. There were some large cap heavyweights which did well, which took the index higher. And if you were in active set of funds, you could have underperformed, because those heavyweights took it higher, and active by design could not have had that kind of participation, because there are stock level limits, etc. Now, conversely, if you were to look at now, where the rally is broad based, I mean, you would find that it is really alpha coming out of stock picking and not out of,
not just a broad index
beta moves or broad index moves, like you said. So that's one nuance. The other nuance is that of investor. Just to add to what Vishal said in terms of asset allocation, risk appetite. what are the index, what is the investor good at? Are you a stock picker? Can you pick up the right stock, or are you better off, picking the entire index? So, if you can find diamonds, then you can go narrow and deep, and you can find it. The other option is, if you cannot, then you go shallow and wide and just grow paddy, which
cast your net
yeah,
wide.
cast your net wide and just
try and catch all the fish.
Catch all of it.
Yeah.
And the third part of it is, while we say passive, it's not really, the index is not so passive, because it has an automatic cleanser. It weeds out the bad stocks, it pulls up the better stocks automatically over periods of time. If you were to look at, jog your memory 40 years back and look at what Sensex used to have, it used to have a lot of textile companies back then, and today you'll struggle to find even one in the mighty Sensex. Whereas the nature of companies have changed, the sectors have changed dramatically, and that tells you that it has the ability to cleanse itself and weed out the not so good ones.
No, that's a great point, that the index itself is a dynamic beast. It's not static. Absolutely. You don't have the same set of stocks in any index over a course of whether it's a twice a year reset or if it's once a year reset. I mean, most indices have an element of churn as well. But Vishal, weigh in on this debate, because I remember we used to get this report, SPIVA, right? S&P indices versus active, and basically these reports, industry reports, used to come out with screaming headlines that XYZ percentage of funds are underperforming their benchmark indices, and that gave rise to the whole argument that if the actively managed fund is going to be underperforming, then why should I pay 2% or 2.5% expense ratio for active management? Where are you on that debate?
So that's still there, Surabhi. I mean, in the large cap space, maybe about 80-85% are still underperforming the index. In the mid cap, I don't have the right numbers with me, but if I remember correctly, it's about 70 to 75% even in the mid cap space. But I think the larger point here is not your ability of a certain segment to beat the index. Right? It's, as he said, it's the ability for you to pick the right stock, the right sector, the right fund manager, the right scheme. I mean, if someone showed me data and said that, look, Vishal, this is the benchmark, there are 5 guys above the benchmark and there are another 40 guys below the benchmark. I mean, it's those 5 guys who are changing all the time, right? How do I pick the right fund manager? How do I pick the right stock? Which will always be a challenge, whether it's a small cap or a mid cap, or, or a large cap in that sense,
But tell me this. So just to complete the large cap versus mid cap debate, and I think, let me tell viewers the reason why I'm taking a step back, in case you're wondering why are we saying that for large cap exposure, passives are a good way. It's because in the large cap universe, there's a lot of information and data available. Large cap companies come and talk very frequently to the media. So therefore, there is no information arbitrage as such. Everybody knows everything. And therefore, maybe the chance of picking a hidden gem is that much lesser through active fund management. That's why that was the point on large caps. But in small and mid caps, where you have a much wider universe of stocks, there, what's the sense? I'll be honest, when I saw the first of the small cap, passive launches hugging the small cap index, I was wondering, how is this going to happen? I mean, you were talking about buying the whole set of 250 stocks, so to speak. But isn't that the exact place where human intelligence is supposed to trump the index, Anand?
Yeah, you're right. I think I can argue on both sides. One is, if like they say, if you know the risks, hedge it. If you don't know, diversify. Small and mid is exactly the kind of place where you can get trapped if you get stuck in a wrong stock. The second best option is why the entire index, it kind of cancels each other out. And hopefully, you end up with a positive outcome net of that. Think about it, because one, it has too many stocks. The point that you made earlier in terms of how much information is available. Do you get to see, hear the management as often? Disclosure, governance. I mean, and then do you have the skill set, time, some of the stuff that we discussed earlier today in the show. So all this makes it very, very complex. What's the second best thing that you can do is, buy the entire index. You at least know that, you will end up mirroring the index over a period of time.
Returns.
Yeah.
At least you won't land up with the duds.
Absolutely. I mean, it's a bit like boarding the Mumbai local. The best seat is the window seat. The second best place is just getting into the train. Both the window seat guy and the guy who's on the train get to the next station at the same time. One can have a rough ride, one may have a better ride.
A breezy ride.
But the point,
when you reach your destination.
But the point is that how sure are you to get the window seat?
Yeah.
I think that's the metaphorical window seat that you're looking for in small caps and mid caps. If you get it right, well and good. Second best option is not so bad.
Well, point well made. Very quickly, 30 seconds, you have to hit a break. But Vishal, he's already made a strong argument of why do passives even for small caps. So you want to add anything?
So they always say that with passives, you'll always be a silver medal, right. So I mean that's all.
At least a silver medal is guaranteed.
So and the chance if you land up with a bronze one could be a bad
silver is
one. So,
better. That's true. That's true. Okay, great. We'll take a quick break on that note, but we continue the conversation on the other side because now there are passive products for thematic funds. There are passive products that are combining a lot of complex factors, the so-called smart beta passive mutual funds. So are they worth your while? We'll discuss this after the break.
Let's talk money.
Welcome back. You're with us on Let's Talk Money, and this week we are discussing passive mutual funds and whether some of the more evolved, newer passive products, which let you invest in, say, certain themes, certain sectors, or certain complex strategies, whether they are worth your while. And of course, we're in conversation with Anand Vardarajan and Vishal Jain. Anand is from Tata AMC, and Vishal, of course, the CEO at Zerodha Fund House. So now, gentlemen, I want to talk about sectors and investing in sectors and themes. And here I always play the investor's self-appointed advocate, right? A lot of funds get launched when sectors are doing well. It's the nature of the market. There's excitement, so defense funds will get launched, or, railway and PSU funds will get launched. And many a times, we've seen that these launches are on the passive category. And that's when, at least, I get sometimes a little, uneasy, wondering whether people understand the risks involved well enough. Anand, what's your thought? Because if it's let's say a defense sector index or any other sectoral index, which is fairly narrow, and then within that it's a passive product, so you're just hugging the underlying index, isn't that very concentrated risk?
Yeah, you're right. I think one is there are fads that you have to avoid, and if it's the most popular thing and everyone and their uncles are talking about it, then you know that this is getting a little too much, overheated, and best to kind of avoid. I think I will distinguish this into two parts. One is whether the story is cyclical or structural. Take the case of, there have been themes like, say for instance, India over the last couple of years, tourism as a theme has kind of evolved, or capital markets for instance, like pre-COVID I think there were about 4 or 5 crore demat accounts. Post-COVID, now we have roughly 20 crore demat accounts, and 15 crore demat accounts have been added post-COVID. So tough to call it cyclical. So if it's a structural theme where we see financialization of savings, we think capital markets group booming and so on, then possibly all the players in the ecosystem, which could be say brokers, RTAs, asset managers, wealth managers and so on, could benefit. So an index of that sort could potentially do well over a period of time.
Okay.
If you were to look at something where, like you mentioned, if the sector is very narrow, very few stocks, hardly even churn has any kind of space because you just keep rotating in and out of the same 12, 15 stocks. That becomes a little tricky to manage, and the risks obviously then become much higher. So you have to really see whether the sector theme is tailwinded, whether those tailwinds are already there in play, and if that is the case, then perhaps it's not a bad idea to look at some of them favorably.
Okay, now let's ask both of you to wear the hat of advisor, which I know could be unfair because you guys are, product manufacturers. But Vishal, maybe give us your own example, or someone in the family, friends or family ask you to create a portfolio using maybe an all passive portfolio or a reasonable blend of active and passive. Just give us a broad composition. What would you go with? Small cap, large cap, sector, themes, etc., etc.
So I'd go for about, keeping in mind that I'm conservative in general. So I'd possibly look at about 40% large cap, maybe about 20% mid cap, about 10% small cap, 15% gold, and the rest in debt is something that I'd look at.
Now within that, that's the question. Will it be all through passives?
Yes, if I think that there is something which, I think that maybe might outperform, like you're saying, if there's some sector theme or some product like that, maybe max 10% of that portfolio I could allocate towards, one of those, I would say, flavors of the month.
Okay, all right. But all fully, passive investing portfolio there, cutting across, of course, some of the segments and asset classes that you spoke about. Anand, same question to you. What's the perfect blend portfolio?
I don't know perfect. It's horses for courses. That's why it's called personal finance. It's
yes.
Not, it's
personally for you. Let me
correct.
ask you.
But I would think that maybe 80-20, 80 in favor of active, 20% passive.
Okay.
And within that, if I were to split, I have a 40-30-20-10 rule,
Okay.
which is 40% large caps, 30% could be mid and small caps, 20% could be some of these kind of sectoral bets that you that I feel convinced about, and maybe 10% is something which I would just keep aside for any kind of opportunity or just some cushion.
Okay, and the 20% that would be passives through passive funds. That would be what kind of passive? Will it be all large cap indices based? What are the other things that you feel very convinced about?
See, some of these sectoral bets is what I could be a wrong investor because I could be slightly aggressive. It could be different for different set of investors, but I would have a slightly more aggressive tilt to some of these sectors or themes, depending on what I feel constructive about at that point in time.
Okay, all right. And what we've not discussed, obviously, viewers, you need to go back and discuss this with your own individual advisors, take your own informed calls, and then decide. First of all, what's your asset allocation, and then within that asset class, do you want to do it through the active route or the passive route? But one of the things that we haven't discussed, one of the greatest advantages of passive investing, that is, it's such low cost, a fraction of what active investing would cost us. Just a quick sense on whether the costs are already at rock bottom, or Vishal, would they head even lower? How do they compare with the global average?
If you look at the large cap ETFs now in the market, most of them are at about 4 or 5 bips, which is comparable to international markets as well. So I don't think in the large cap space, you can go down any further. At this point of time, mid caps and small caps and the other products are, products which are still gaining economies of scale. And, once the industry or those products get economies of scale, I mean, slowly costs will start coming down in those as well.
Okay. Your final tips and advice, I mean, the checklist, important checklist to keep in mind before you go in for passive investing.
I've said all that, Surabhi. Asset allocation, look at a core and satellite kind of an approach, and keep investing at regular intervals in the market.
And when you choose within passives, are there any metrics to track or parameters that you should be aware of?
So if it's if you're looking at index funds, then definitely look at the tracking error and the expense ratios. If you're looking at ETFs, then definitely do look at the liquidity as well as an additional criteria.
Okay. And Anand, your final piece of advice to our viewers?
First, don't fall for fads. Be very clear whether you're getting into something which you understand, first of all. Second, this active passive debate is kind of overdone. I think you should have a blend of both, because each of these work differently at different points in time. 3, cost to customer that I look at is basically your tracking error, tracking difference, plus your cost. I think overall you should really look at it in toto and see whether it makes sense, because TETD becomes an important thing to look at when you're investing in passives. So please pay attention to that. Yep.
Okay. All right. I think that's a very helpful advice, and it's a good mini classroom on passive investing for those who may not have started so far. Thank you so much, both of you, for joining in and giving us important context when it comes to passive funds. Thanks for joining in.
Thank you.
Thank you.
Well, with that, we're out of time on this edition of Let's Talk Money. Thank you so much for being with us. Keep sending us your feedback, comments, and queries. We'll see you again next week with another theme.
Let's talk money